Facilities LiveXchange in the TFM Forum. My name is Ted Coney. I'm the co-president, along with my sister Susan, and a lot of you on the TFM side now, Group C Media, which is the parent company of the two magazines, Today's Facility Manager and Business Facilities. When we selected our keynote speaker many months ago, we knew the economy and the credit crunch would be issues. It's now morphing into a more credit card situation. It's going to get worse for a while before it gets better. Hopefully, our speaker today, Jeff Finn, will be able to tell us more. He's going to be our keynote today. He's with NAI Global, CEO of NAI Global. They have 165 affiliated commercial real estate brokerage firms and 325 offices in 55 countries throughout the world. They're the world's largest managed network of commercial real estate service firms, and the NAI system is involved in over $45 billion in real estate transactions annually. Jeff is one of the founders of the company, and over the past decade, he has helped lead the organization to its current position of industry prominence. Jeff holds a bachelor's degree from Boston University School of Management, where he graduated cum laude. He holds a New Jersey real estate broker's license and serves on the NAI Local Board of Directors and the NAI Cares Foundation Board of Trustees. He is a trustee for the Penny School and is a founding member and past advisory board member of the University of Pennsylvania Wharton Real Estate Center. He has been recognized by numerous trade periodicals and associations throughout his career. I'm sure you're anxious to hear that Jeff will tell us that the apocalypse is not imminent, and our retirement portfolios and houses will be worth something again someday. So without further ado, please welcome Jeff Finn.
I appreciate it. I appreciate all of you joining us this morning. And like Ted, I always like to be here in California. Coming from New Jersey, see a different beach, different coast, but it's always nice to speak in California, to make a presentation here, to talk about what's happening in the world and what's happening in the real estate industry. You know, California is the only place where the 10 Commandments are taken as 3 suggestions and 7 good ideas. One of the 10 Commandments, I think that they didn't quite get right, was about lending. And it's appropriate to be here in Orange County, which is really, I guess, you could consider ground zero for the subprime crisis that we're now in, and the problems that we're facing that seem to be limited to the credit markets, but are now spread throughout the world, global financial markets, as well as the general economy. I think unlike past cycles where there have been tremendous problems in the financial markets, this time our government acted very quickly. In the past, governments have acted slowly in trying to allow the market to respond and adjust, and only when a 9/11 or the type of crash that we had in 1987 did government really step in quickly and try to respond quickly to make sure that the decline wasn't as precipitous as it might be, and limited it to the financial market and trying to keep it from spreading throughout the general economy. The times have changed so much since the day that I got the call to say, would you like to speak here, to thinking about what I would say versus what it was at 8 o'clock this morning when the time is smart, because it's changed not just sort of week by week, but almost minute by minute through that process, where the things that you might have said a week ago or a month ago are much different than you might say today. When we were originally thinking about this and sort of drafted the initial concept for what we were talking about, the dollar was tanking, oil was soaring. We had a private banking system. You had the financial market. You had China and India still roaring. The Middle East, when I talk to my friends there, they say it's a boom time. And so quickly, things have changed. We had a market that was very heavily U.S.-oriented as far as the problem. But it very quickly spread to the UK, then very quickly spread to Europe. And then it hit even the roaring China and India markets and other emerging markets throughout the world that are now facing crises. And it certainly is not. You'll see in some of the comments that I have in some of the charts and statistics that we faced much more difficult times in the past. And yet, whenever we have faced difficult times like this, the opportunities have been tremendous. And the real money in financial markets or real estate markets and the opportunities that are presented at times like this. At the top of the market, it's very difficult to navigate. It's very difficult to find the opportunity. You don't know where the risks are. You don't know where the peak is. Now we know what the problem is. This is our wildfire. It's quite an amazing chart, I think, to see how slowly a build and then a peak was built in our CMBS market, the commercial mortgage-backed security market. This is a market that emerged out of the last crisis, really, in 1992. Market crash and the recession of the early 90s. There was this fear and discussion of there's no liquidity in the market, there's no money in the market, the S&Ls are all gone. How are we ever going to get back in the game? And the genius of America, and the genius of the world and of the financial markets is there's always a way. There's always a new source of capital, a new source, a new method to deal with the issues of the day and build a new model to emerge. And it did emerge. But as I mentioned, the greed builds slowly, and the opportunity rises to a peak, and then you start over again. But fear hits like that. So last year we hit the wall. 2007, over $250 billion worth of mortgage-backed securities, the commercial mortgage-backed securities hit the market and were put out there. And it was good times. Yeah, yields on buildings were very low, rents were skyrocketing, and no one saw the end in sight. But just like that, it all changed, and this year virtually no credit hit the market. And what was isolated, it seems, where we had a real estate market that was separate and apart from the financial market, we're now facing a 1-2 punch. The first punch was the financial crisis, which dried up trading in the investment side of the market. There was virtually no sale of investment property of any significance this year. The market declined about 75%. Think about that for sales of commercial real estate investments off about 75%. That's staggering. But going into this cycle, and even until a few months ago, the real estate fundamentals were quite strong, and still are. Vacancy rates are low, rental rates are high, and demand had been steady. But the credit market decline now spilled over to a marketplace decline, and the deer in the headlights that we have with corporations now saying, we're not going to do anything if we don't have to. We're going to wait and see. We're going to wait and see what happens with the election. We're going to wait and see what happens with the financial markets. We're going to wait and see what new policies are put in place and how we need to respond to them. Once those rules are written, as they are being written now, things will pick up again, and they'll pick up from a fairly solid base. Where, again, last year, if you looked at it by historical terms on most all fundamentals in virtually every market across the United States and truly the world, vacancies were at historical lows and rental rates were at peaks. So even with a declining market, which we do expect where the slack demand will come into the market in 2009 and not really begin to pick up until 2010, the balance was there and there was very little new supply coming into the market. Unusually, as in past cycles, you typically had a real estate problem when there was lots of supply. It wasn't for too little demand, there was lots of supply. Overbuilding. We didn't have overbuilding this time. We had too much credit and too much trading, putting values up at unsupportable levels, but not the new development that couldn't be supported. So we have an interesting opportunity where we're going to have a valuation adjustment. Prices will come down, rents will come down, but we're not going to have a supply and demand imbalance as we have had in the past. This is an unbelievable time as you think about what's happened in the world and to think about the icons of industry faltering as they have. Who could have imagined that Merrill Lynch would have to be sold, or Bear Stearns would fold, or Lehman Brothers would go away, or AIG, as you mentioned earlier, would be bailed out and then bailed out again, it seems, and restructured, or that General Motors and Chrysler would be in the position that they're in. I guess you could imagine that. You could imagine that they've been in trouble for a long time and teetering forever, that this type of economy would really push them over the edge. And that the world would respond as it has, really flooding the market with money and all acting in a way to lower interest rates, bring capital to the market, and try to slow down the decline and support at once the reemergence of the global economy. Now, these aren't normal times, but as I mentioned, and you think about it, as the fire from New Jersey looks like it's covering the landscape in California. When we would talk to someone in Europe, they think that we were in bread lines here in the U.S. And you think that people couldn't drive, couldn't go to hotels, couldn't fly. There was that level of decline. It isn't. You go to stores, you go to planes, you go to hotels, and there's still a vibrant economy out there. Not as strong as it has been, and not as strong as it will be, but certainly not the challenges that we've had in the past. There aren't lines for gasoline. We don't have 18% interest rates that we've had in past cycles. We don't have 25% unemployment that we've had at the Great Depression. It's nowhere near that. The average length of the recession is about 10 and a half months, but the worst of recent times was 17 months, hit both in the early 70s and the early 80s. This we expect to be just about 12 months. Most of the forecasts and the research we've done indicates that we started the recession about last quarter and then ended about this time next year. So by the end of 2009, we should be beginning a recovery and strengthening again. The decline is also tempered by China and India, where their growth is not 10 and 11% anymore, but still 8% is not bad, or 6% is not bad, as they continue to motor along and have demand for our services. The types of issues of today are looking at what you need to do today to take advantage of the opportunities in 3, 5, and 10 years down the road. These are times to get into the market. There are places and cities in the U.S., I mean, to find space in Manhattan last year almost couldn't be done. You would need to be standing there when the space came on the market and be in line with the other 10 bidders for that space and pay a ridiculous amount of money to get that opportunity. Now, if you need to enter into that market, you can. Or buying land for a retail site in New Jersey or New England, other markets that were so tight, so difficult to get through. Now, all of a sudden, there's more accommodating government, there's more accommodating local markets, there's more accommodating landlords or sellers say, we do want your business, we do want your retail operation to come in, or your new distribution center, that they may not have been so interested in before. So really, it's a time of opportunity to be thought of and looked at, both the corporate and an investment side that doesn't always happen. And this indeed might be one in a generation for us. Looking around the room here, some were here, some involved in the market in the 1990s, but you look at sort of the full gambit of that cycle. Sam Zell came into the market and really created the new day REIT market. And he did it in the early 90s. He gobbled up as much property as he could. He bought everywhere. He built the biggest REIT in the world, and then he sold it in 2007. So he rode it perfectly from the trough to the peak, but he made his money when he bought the property. He knew when to buy the property. He knew when to enter the market. So this is a market that's inefficient. There's no liquidity, and if I can bring liquidity to the market, I can take advantage of it, and I can make money for my investors. And I can make money for all the stakeholders in the enterprise. So today, again, that type of opportunity emerges, and we have probably a 12 to 24 month window to really take advantage of that before REIT comes back again and starts to push the market forward. So the cyclicality of real estate industry, the cyclicality of the global economy really go hand in hand, and we're not going away. History will repeat itself, and as I mentioned, the fundamentals are even stronger today than they have been going into past cycles. So remember this and be thinking about where are we. You try to figure, is it today or is it next month or in a few months? But there's opportunities to start moving into the market in different ways at different times before it really starts to take off again, and it will. It will come back again and be, I think, better than it has been in the past because, again, new technology, new ideas, and new structure will be put into some of the debt side of the market to protect from the severe over-leveraging that's taken place this time, but to allow appropriate level of leverage to reemerge and refuel the market for growth and success. This is just a highlight of some of the key areas of the world that we're dependent on right now. It's the BRIC countries of Brazil, Russia, India, and China, which, as you see from all estimates, are declining in their growth from peaks of 10 to 12% to 8 or 9%, but still very strong growth and substantially balancing out the minor negatives in the industrialized, the developed world. So while we're declining and the Europeans are declining a point or so, the others are growing much more rapidly. And when you look at the balance, and I've got one more chart coming in a couple of minutes, but it shows that right now the world is almost balanced, with global GDP being about 55% developed world and 45% emerging world, which is much different than it was 5 or 10 years ago. before China and India really came into the market, those statistics were like 20-80. Now being balanced, the fuel and the strength of the emerging markets really does carry much more weight in the overall growth, and it mitigates some of the declines that could take place if we weren't as connected in a global economy. But even in the U.S. without that, and this is a little bit harder to read, but a testimony to the strength of the U.S. economies. Even with $150 gasoline, we continue to motor along, we continue to grow, we continue to have success as an economy. And it wasn't until the complete shutdown of the financial markets and zero liquidity, that constipation in the marketplace, that really ground the world to a halt. And it's not everywhere, even yet. Certainly, many markets are still growing. The markets like Houston and Dallas and San Antonio, markets like Charlotte and even Chicago, Raleigh, Seattle, are solid performers. San Francisco, Boston, where education, highly educated workforces and jobs are being created. Then there's jobs, there's opportunities or challenges in markets like California, particularly Southern California, and Ohio, Detroit, Phoenix, Las Vegas, and Florida, where the real overbuilding in the residential side, that construction wave on the residential side that created so many jobs, the financial engineering to fuel that in the credit markets or the countrywides and the other mortgage brokers, the title companies, all those jobs rippling through it and phasing out led to a significant decline. But the job losses and the impact are isolated. And we talk to people in Tennessee and the Southeast and other parts of the country. They're not feeling the pain much like you might feel it in Las Vegas or Phoenix or Tampa and some of the markets that are really the hardest hit and the centers of the problem from the residential side. Here's that weight balance that I mentioned earlier. You see that the U.S. accounts for 25% of the world growth, so still the biggest and most important engine. So when we do fall by 1%, that is significant. It does hurt the world. But when the rest of the world is still growing, 45% of the world as an aggregate is growing, that props us up as well and will pull us out of this problem faster than we might. If you look back at the 1980s and saw that when Ronald Reagan came to office, he came into a recession, he came into a really bad situation, challenges all over the world and all over the U.S. in a very difficult market with high interest rates, high inflation, high unemployment. But he's remembered for ushering in a new era of growth. He happened to come into office and he did the right things, but he came into the office at the time where we were at a trough, at a difficult time, and was able to take the right steps and the right measures and be the right type of leader to take us forward and to reestablish the United States as a world leader, as an economic powerhouse. And while we don't know the results of what will come, but we have a new president now and a new stage set with a very challenging time with wars and recession and a failed social security system and problems in healthcare that all need to be dealt with. But now we've got, it seems like, the public commitment and the governmental commitment to deal with them and to deal with them well. And coming from this type of challenge market that we're in, I think we'll look back at the 2010s, that decade, as a new era, ushering in a new era of prosperity, success, and world leadership for the U.S. Remember that as we're connected, China and India and Central and Eastern Europe and Asia and the Middle East aren't going away. We're all connected together. They are all still growing quite rapidly. And they need our technology, they need our intellect, they need our services, they need our tools to emerge their own economies. There's hundreds of millions of people that are just beginning to enter the world economy as those countries lift themselves up and tie themselves more and more into the world themselves.